Hello everybody, Randy Patrick here. Time for Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Tuesday, July the 16th. Hope you're doing well. Hope your summer's treating you right and you're traveling or having a good time doing what you need to do to relax and get ready for what's going to happen in September. So anyway, lots going on again. Today I'm going to talk about a few things. I'm going to have a little more focus on more of a topic towards the end of the video. So I want to give you a heads up on that. And really it's time for a reality check. So I think we have to do a real estate reality check to see what the heck is truly going on in the marketplace here. Because as far as I'm concerned, I'm seeing a lot of conflicting information out there. We're being told one thing, but we're seeing something else in the numbers here, or we're seeing how things don't quite equal what people are talking about. So I think we're going to go over that today and get a little more involved in that. By the way, if you're not already a subscriber, please help my channel grow and click that subscribe button. I'd really appreciate that. And also for those of you that have reached out to me, appreciate it as well too. I've done my best to get back to people. I know some of us are still playing some email tag. If you'd like to talk about real estate, buying, selling, investment opportunities, how to drive prices down on your purchases, things like that, short sales, stuff like that, training, I've got it all for you. Email me, so I'll have my email in the top comment section here, but definitely email me first. That's the best way so I can track it. I'm not good with the phone, with voicemails and losing calls and whatever, or forgetting about them. So email is definitely the best way to initiate discussion. So having said that, let's get started today. So in almost a little bit, a couple, videos ago, I spoke about how Realtor.com actually, put out, a little bit of information and had some, you could say, some reports written about it, talking about the future of housing and how they've seen some inventory decreases. And if the trend continues, the expectation is that we're going to have a lot less inventory maybe towards the end of the year, and buyers could face bidding wars. So, to me, that's an inflammatory type of statement. That really is saying, hey, better go out now and buy your homes because we're not sure what's going to be around back in the next, or in the next few months. So to me, that's just really, kind of a baiting situation here. Well, funny enough, Redfin puts out something the other day, and they call it what's called the death of the home buying bidding war. So, the U.S. home purchasing market's cooling off, and buyers are now 4 times less likely to face a bidding war than they did 12 months ago. So again, that certainly has changed dramatically. Last year, things were a frenzy. People were overbidding. That helped drive up prices and drive up values. Things are different now. So it's 4 times less likely since last year. 12% of buyers in June faced competitive bids compared to 50% a year prior. With San Francisco remains the country's most competitive market, but the share of listings in the city that received multiple bids fell from 65% to 28%, and that's kind of good. That's kind of good. And also, this is despite housing borrowing costs falling again. The recovery has been slow to kick in. So even in the top most competitive market, it's gone from 65% of listings getting a multiple bid to 28%. Now, this is just Redfin statistics. So Redfin is talking about what they see with their listings and their activity. But I would have to imagine that Redfin has X number, and their sampling is probably I guess you could say competent and done thoughtfully, and I would say the sampling is probably indicative of what the overall market is in some of these areas. So what they've seen, vanishing bidding wars. So obviously San Francisco, we've dropped from 65% to 29. San Diego went from 61 to 19. Boston's gone from 72% to 17%. New York from 56% and 15%. Los Angeles from 67% to 14%. Denver from 50% to 12%. Sacramento 50% to 12%, Portland 48% to 12%, Seattle, Washington 53 to 12, and Vegas 50, looks like 56 to 12%. So, I really think that's interesting. So, Redfin, obviously they're going to be in a lot of the major metropolitan areas, and if it looks like almost 50% and and above for these last year we're receiving multiple bids. Now we're talking significant, like everything is below 20% except for San Francisco. So that's significant drops right there. So what does that tell us? It tells us that the market's cooling. It tells tells us that despite low interest rates, that home buyers aren't jumping through hoops and they're not going to engage in bidding wars, which ultimately means that inventory is sitting there longer in the market. And that's, to me, acceptable because, as buyers come on, that inventory is not drying up quickly. So, this is a little different compared to what we hear from Realtor.com, which we expect. So again, I have to laugh and go, it's funny that what we hear from them is in total conflict, or it's a complete 180 from what we're hearing from these guys over here. But again, it's all like, this is hardcore numbers, and all Realtor.com doing is saying, hey, we see a potential trend, and if that trend continues, this could happen. So again, we use the word could. It's not saying it will happen, it could happen. But still, what it does, it confuses buyers. I think it puts pressure on the market, and it puts undue pressure on buyers to jump in now, which, or pay higher prices, or maybe do things they're not quite ready for with the fear of missing out. So back to the whole FOMO issue. So again, that's what we see in the marketplace. Every so often, people will comment, or they will also email me saying, Randy, can you please do some analysis on my local area? So typically when I go through the information, I'm picking off stuff from various websites, various information portals, and I'm really only able to talk about what is produced and what I can see. So first thing, for everybody who wants to know what's going on in their local market, the first thing I would suggest you do is contact your local real estate board. Anywhere you live, you're going to have a local, association of realtors, local real estate board. Call them directly or go on their website. The majority of these locations do actually, or these groups do post housing trends and housing statistics. Typically it's, last month. So, I can pull, May's data or April data, coming up type of thing. That's just happened. So, essentially, that gives you an indication as to the activity, how it's broken down. You're looking for basically, sales activity, is sales increasing, sales decreasing, is inventory going up, is there more listings? You're looking to see what also the year-over-year trend is and month-over-month price trends and sales trends. So again, start there, and you can ask for that. That's where I'd go, and they should point you in the right direction. There are some locations that I've tried to do my own data mining on in certain parts of the U.S. that their state and their local association do not produce or show that information to the public. So that typically means you may have to go to a local real estate agency if they can pull the information for you. But go there first. So having said that, if I have data, I'll talk about it. So people have inquired about Hawaii, and just so happened that yesterday I saw something on Hawaii. So report from the Garden Island on Hawaii, or this Garden Island, which I guess is a Reporter magazine. Real estate market remained relatively strong in the first half of 2019, but overall sales figures across the island are down from this time last year. And really, it says anything under $600,000 is moving really quick. Homes listed in the $600,000 to $900,000 range are sitting on the market a little longer. Anything over $900,000 and up over $1 million has been kind of hard to sell. So median prices island-wide are down over 12% so far this year compared to 2018. That's down from $732,000 to $643,000. So the North Shore and looks like Kaloa single-family home markets have been hit the hardest so far, with homes selling about 17% to 18% less than they did last year. So again, that's just what's going on in Hawaii. So like any market, obviously Hawaii being an island out in the Pacific, I've never been there, so I don't have the pleasure of or the deep down information about it. But obviously I know a lot of people that went there, and it seems quite beautiful and it's quite lovely. Obviously, real estate prices are higher just because of the nature of that situation out there, being an island and being a very nice island. But like any market, it's going to have peaked, which looks like it has, and starting to come down. So like anything, it only can support so many buyers at a certain price point, and it has to come down. So there you go with Hawaii. Excuse me. So this just came out the other day too. Every so often, every month, we hear something called builder confidence, all right? And according to the National Association of Home Builders / Wells Fargo Housing Market Index, that the builder confidence for single-family homes rose just 1 point to a number of 65 in July. So it just rose from 64 to 65 from June to July, according to the National Home Builders Association of Home Builders. The sentiment is well below the 68 score it was a year ago. Anything over 50 is considered positive. So clearly, it says builders report solid demand for single-family homes. but they continue to grapple with labor shortages, a dearth of buildable lots, and rising construction costs, making it increasingly difficult and challenging to build homes in the affordable price points relative to buyer incomes. And even as builders try to rein in costs, home prices continue to outpace incomes. All right, that's the chief economist for the National Association of Home Builders said that. The current low mortgage interest rate environment should be getting more buyers off the sidelines, but they remain hesitant due to affordability concerns. Now, why I find this kind of interesting, because we can talk about how the economy affects real estate, and there's certain things that we don't talk about or people avoid talking about. Sometimes, in groups like this or mainstream media, they do it when it serves its purpose. Well, for how many months or the past couple of years, we've heard about the economy's growing, jobs, unemployment's down to its lowest level. So all these great things are being shown to us about the economy and about job, whatever. But now we're looking at wages. So, if we do some investigation, it's clear that wages have not kept pace at all, anywhere close, with house price growth. And we're off the mark pretty big time here. And now we're seeing people, and what I mean by that are economists or those people that are the leads or the voices for specific groups, calling it out, saying, hey, this is a problem. So they're actually stating this. And what happened before, we never heard that. It was just numbers, and we weren't really we weren't keen into those numbers, or they weren't being talked about too often. But this time around, with the housing bubble and crash and crisis, we're hearing a lot more information, we're seeing a lot more information, and people are commenting a lot more, saying this is the reason why. So it may not necessarily be the complete reason why, but as well, they're looking at this as, whether this helps builder stock prices or alleviate investor concerns, who knows. But the point is that people now are coming out saying we have issues in housing because of affordability, and affordability is due to the fact that wage increases have not kept up with housing price increases. So there you go. So what does that tell us? Well, if affordability is out of control, in order to sell more homes and move more property, then guess what has to happen? Price has to drop. Simple as that. So it's a matter of supply and demand in that capacity. Just as a FYI for something interesting, Americans spent an average of $9,000 and change on home improvements in the year of 2018. So there's a place called Home Advisor, and they indicate that consumer spending on home improvement projects increased by 17% last year. 2018 was a robust year for overall consumer spending on home services. So they break it down into three categories to get to that 9,000 and change number. They bring it down to average home improvement spending, which is about $7,500, average home maintenance spending, which is about $1,100, and average home emergency expenses at just over $400. So you got your improvement, like I want to fix things and make it better. You got maintenance, stuff that just has to get done, and then you have to be fixed because it needs it, deferred maintenance, and emergency stuff, which could be water lines, air conditioning units, whatever. So it just goes to show that I guess that's up. So what that also indicates to me is that when those type of numbers increase, it means people are staying in their homes longer. And we know that with respect to, we know housing tenure is longer. It's around 8 years or so now. It's been increasing the past little while. May have decreased every so often when the sales numbers pick up, but it's slowly been increasing. So if people aren't moving, which means no more properties not coming on the market as inventory, they're staying put, which means they're going to spend more money on improvement just by nature of it. And as homes get older, the deferred maintenance builds up the cost points, and also having, again, AC unit craps out, or your Freon goes, or the catalytic or the capacitor goes. It's down here in this area. That's what happens all the time. You get a clogged drain line, things like that. So again, more problems happen the older your home is, and this would be an indication that people are staying in their home longer, which we've talked about in the past year. Hurricane Barry, of course, hit through Louisiana, and an analysis by CoreLogic shows that over 300,000 homes in Louisiana face danger of flood damage due to Tropical Storm Barry. So that's not a good thing, and that storm's been lingering, and it's causing a lot of water and flooding. It was flooding before it hit, just with the whole frontal part of the storm, and it's been causing a lot of damage there. The report states that only 32.6% of homes in the state are located within a special flood hazard area where homeowners are required to purchase flood insurance in these designated areas when their mortgages are backed by the federal government. So the issue, what you see sometimes, is that, as storms get kind of bigger and their paths, encumber more land and problems increase, say outside of the flood zones, the people that actually get hurt are the ones that aren't required to carry flood insurance as per their mortgage lender, but still get flooding and stuff like that. So what you have happen is that there's more damage. They have higher deductibles, which means they don't end up getting insurance claims paid, or they have to take money out of pocket, or in the end what they do is they just don't fix the problem. The problem gets worse, then it turns into a home you can't live in. Anything that's flooded, that has water damage, don't fix the problems and remediate, especially in a hot area, southern area like Louisiana, you're going to get mold issues, mold and quick deterioration. Then people eventually are going to leave their property, not pay their mortgage, and things will escalate. So this is what happens. I mean, we've talked about it before, and we've, I guess you could say, the government has already talked about, disaster, efforts for people and housing in these issues, which they'll do and they'll work on. But in the end, it's going to be, it's economics. In other words, if you're not in a designated flood zone where you've carried flood insurance and your home floods, you're going to have a much higher deductible, and you may not be able to have the money to pay the deductible and get your home fixed, which then starts the cascading sequence of events that causes problems. So again, our thoughts and prayers for people out there. Let's hope that everyone has been safe, and at least it was a Category 1 to a tropical storm, so that was the only saving grace there. That wasn't, and the storm surge was there, but not huge. So that's, I guess you could say, good things that happened with respect to a disaster and a tragedy. All right, so back to the whole real estate reality check here. So that was a bit of the news. I want to talk about this, and I'll post this link in the information section of the video. But what we got going on here is, the U.S. housing bust in a bunch of charts. So I'm just going to read the charts, the title of the charts here, and you can take a look at this and kind of go, okay, this starts to make sense. So for me, it's, housing bubbles and housing busts and crises and crash. It happens because a lot of small things or a lot of little pieces add up to one big piece. And this is what we have here. So if we talk about this here, so here are the main highlights. Well, single family starts and permits rolling over despite lower mortgage rates and low unemployment rate. So again, builders are just not building houses. They're not building houses in the affordable home segment marketplace. And that statement going even or despite lower mortgage rates. So again, rates are back down. Why aren't people buying? It comes to the affordability issue once again. So we see trending. Housing starts are trending down. Existing single-family home sales and new single-family home sales not rebounding despite very low mortgage rates. So same thing. So the past, couple, month or 6 weeks, whatever it is, we've seen lower rates, and we're not seeing the sales, uptick in pendings or closed sales to show that that's been an incentive to bring buyers to the marketplace, which shows us there's still something else wrong with the real estate industry here. So these are just sort of things to think about. We got lower mortgage rates and low unemployment not doing much to boost consumer plans to buy a house. So, polling people saying, what do you plan on doing the next little while? Well, we've heard a lot of the millennial segment saying, we're not buying, we're going to rent. And the perception is that, everything is still too unaffordable. It may not just be perception, it may be what they're experiencing. So, even though rates are lower, not plan on buying in the future. Residential investment is shrinking despite lower mortgage rates and low unemployment rate. Well, residential investment, I would look at this as really meaning purchasing homes for cash flow, real estate investment, rentals, whatever, maybe even some fix and flip, whatever you want to do with that. Well, that's on the downturn. And again, as prices increase, you don't buy a home at the high price point to make a rental property, with a mortgage, because the minute it drops and then eventually rents drop, you got a huge mortgage nut to pay, and your rents may decrease. So you're getting squeezed there. So again, real estate investment you're going to see is pulling back Your basic mom and pop stuff. I'm sure from a larger perspective, I know a lot of people have pulled back as well too. They're doing things a little differently right now. What else we got here? We've got year-over-year growth in housing components as a contribution to the gross domestic product has decreased. Just plain interest in home buying overall is declining, it's rolling over. That's from single family structures to multifamily to commissions and whatever. We just see all that sort of dropping, which is interesting here. Home price appreciation is trending down. So yeah, we've talked about that before when we see Case-Shiller and we see the Redfin numbers, etc. So year-over-year appreciation, it's deceleration now. So that's what's happening. That's the trends. Fewer subprime borrowers are available today, but more people with top credit. There's fewer subprime borrowers today in that category, and more people with top credit scores in their category, and still housing is cooling down. So, i.e., we have a larger pool of better qualified borrowers, and they're not buying. So that's got to tell us something, right? Only 30% of the population have a subprime credit score, which that is actually less than it was back in the last housing crisis. So again, you got better qualified people available, but they're not buying. Almost no distressed home sales, and what I mean by that is the component of sales that are every month that are distressed, which in this category would be short sales and foreclosed homes, otherwise known as REO, real estate owned. So there's just less and less of that going on. There's a couple of reasons why. There's obviously traditionally, historically, less distressed property out there, but as we mentioned, the distressed property from the short sale marketplace and the REO marketplace, there's less home sales because less homes are available. That's the shadow inventory. From on the REO bank-owned side, there's not much going back out in the marketplace because people are buying them at the auctions, at the county or city auctions. And then when they're taken back by the lenders as a foreclosed asset, some of the servicing companies have their own auction platforms that they utilize to sell properties. And then a lot of these are actually sold to and transferred behind the scenes as non-performing assets or loans between lenders and hedge funds, etc. So there's a lot of behind-the-scenes buying and selling going on that you never get to take a look at. So what that does is, distressed properties that should be sold for less don't come back out in the marketplace to become available for buyers who can purchase them, which also helps move price points down, an overall drag. That's on the REO side of the shadow inventory. On the short sale side, to me, which is pre-foreclosure, the pre-foreclosure market's not being marketed to, and it's usually a mindset with the homeowner, and I can talk about this ad nauseum, of course, but the point is that market's not being serviced, so those people aren't coming to the surface and saying, help me. So therefore, we're not seeing those short sales hit the market, which traditionally are lower priced homes, which I can show you the numbers and I can show you the equity that are in these homes. You may want to ask me about that because it's quite astonishing, and that market's not being served, which I think is a fabulous opportunity. So again, just to add to this is that distressed property back in the last housing crisis, as we came out of it, a lot of it was available. Well, things have changed now. The way the lenders do things and the way Wall Street works and the government, we don't have access to the same things we used to before. So only certain groups do. And those are big money Wall Street players, etc. All right, if I continue with this, we've got homeownership rate is still far below its peak, again, despite low mortgage rates and low unemployment rate. So going back down to what we think triggers the economy, hey, lower interest rates and people have jobs, well, that's not equaling an opportunity where people are going to go buy property. So there's a disconnect there, and everyone, we're just starting to realize this right now. It's becoming very clear to us what's going on. Since homeownership rate peaked in 2006, the number of households renting has increased by roughly 10 million. So if you take a look at that, so we had a peak, we had the foreclosure housing crisis, and now we have, this increase in rental activity. So 10 million households are renting more than they were back since the last housing peak. So that tells you something right away there. Again, people prefer to rent for whatever reason, the perception of homes being unaffordable, or the fact that they don't want to do it. Maybe our 10 years ago, 20 years ago's perception and need to own a home and have home ownership is not as critical or as a goal set up as it was then, as it is today for people. Maybe they're doing other things first before home ownership. And fewer people plan to buy a home within the next 12 months. Again, despite low interest rates, despite low unemployment. So all these things we talk about, have the caveat: low interest rates, low unemployment rates. Something's not adding up here, people. Mortgage refi application is up, but not too much, taking into account how much mortgage rates have declined. So again, people who are going to refi, why are they refiing? Is it just to get better rates? Possibly. Is it to take cash out? That's usually more what happens when people refi. It's usually a cash out component, because we're not going from a 7% rate to a 3% rate. We've gone from maybe mid fours to higher threes. How that works out in the end, I'm not too sure how much percent payment or how many dollars per month that'll decrease for your mortgage. It's all, of course, depending on how much you have and what you're doing. But maybe the fact is that refi is not necessarily rate based; it's more of I need money based, and that's what's happening. So mortgage rates have declined, but maybe people feel that they're tapped out, or if I take money out, what am I going to do with the property? Like, who knows, right? But again, we've seen refis were bigger a couple years ago, and the past few quarters you've seen it kind of slow down again. So even though a lot of the applications are refi applications, true refis have slowed down. So that's kind of what we got going on here, which I think is kind of interesting. And again, as far as I'm concerned, we have something I can't show you here. It's more of a chart, geographical distribution of housing boom and bust. So obviously you're going to see coastal areas and warmer areas with more boom bust scenarios than you're going to do in the Midwest. But having said that, we also know that we're seeing foreclosure filing increases in a lot more different locations other than your major mega cities and your coastal cities as well too. So typically you see where you got high appreciation, you get swings, you see a lot of foreclosure activity. Every month now when we get the reports, we see Ohio spiking, Illinois spiking, other Louisiana. That's a little different though, of course, but it's coastal. But we see other locations spiking with pre-foreclosures or foreclosure filings, which to me indicates that again, these are signs. So I look at it going, it's signs. When you take a real estate reality check and you take a look at everything that's going on here, and you add it up to what? We have low interest rates now. It's not stimulating buying. We have low unemployment, but we've sort of proven out the fact that, and what we hear from other economists and people, that housing price increases have outpaced wage increases. There's a big disconnect there. So we're kind of wallowing in this situation, and then we get, of course, the propaganda and the baiting of, hey, you better go buy property now because I think we're going to see, lack of inventory in the fall and we'll see bidding wars again. Well, I don't think so, because all the things we've talked about here in this reality check, as far as I'm concerned, indicates that there's less interest for housing and there's less demand for housing, and or people are waiting, as we've talked about many times, waiting to see some more movement in housing before they decide to purchase a home. And that, I think, is the big difference here. So again, real estate reality check, I think it's important to review things every so often, but when you put it all in perspective, and that's what I like to do, is I like to look at the trends, I like to see the information, and when I see it all kind of at once, I'm like, okay, we got an issue here. Or not an issue, but we have, what's going on in the marketplace is indicative of maybe larger things to come. And you can see that certain groups are trying to push their own agenda, which they have to, clearly, and push the buttons to get us excited, saying, hey, you better buy, whether it's scare tactics, fear of missing out, whatever that is, it's up to them how they want to portray and use that. But I think that a lot of these trends here, that buyers are steadfast in what they're doing, so they're not triggering, they're not jumping out there and jumping through hoops and listening to this, and maybe buyers are more information based now, because there is more information on the internet and there's more people talking about it. There's more statistics available, and people can make much better educated decisions as opposed to running and buying on emotion, which I think is a good thing, that you use your brain and look at the numbers as opposed to using your emotions when you buy, especially that your house is usually your biggest purchase you're ever going to make in your lifetime. So you got to take care, and you got to do that appropriately and effectively to get the most out of it from an economic and from an enjoyment perspective. So anyway, having said that, thank you very much for the views and indulging me in my discussion here. Again, if you're not a subscriber, could you please click the subscribe button, help my channel grow? I appreciate your likes and comments. Share the video if you could. That again helps us grow. And reach out to me if you've got questions on real estate investment, short sales, foreclosures, never paying retail, like I say before, and driving price down your purchases. So again, thanks once again, and we'll look forward to talking to you later on the week.